I'm Benjamin Ensor, Director of Research and Strategy at 11FS, and this is Fintech Insider News. This week, we're talking about Philadelphia's Republic First Bank lives up to its name for all the wrong reasons, becoming the first US bank failure of the year. Regulators stepped in after they failed to bring down costs, and a potential funding deal fell through. Its assets, as well as its 32 branches across the Northeast United States, have been sold to Fulton Bank. Visa is rolling out open banking services across the states through its Tink platform. The new services will unlock open banking for millions of Americans, just as new open banking rules make their way into law expected by the end of the year. And a former insurance consultant in Australia is taking her former employer to court. The company let her go after using keystroke technology to monitor her performance, but she claims the data is wrong and that she was unfairly dismissed. We discuss all of this and much more on today's show, so don't go anywhere. Welcome to episode 852 of Fintech Insider. I'm Benjamin Ensor, Director of Research and Strategy at 11FS. I'm joined this week on Fintech Insider News by two guests who are here to break down the biggest stories from the past week in fintech and financial services. Firstly, I'm delighted to be joined by Jonathan Fawkes, Head of Partnerships and Propositions at Thread. Welcome back to the show, Jonathan. Please, can you tell our listeners a little bit about you and what you do at Thread?
So I'm somewhat depressed that I've been working in cards and payments since the late 80s, 10 years at American Express, then 20 years at Visa, and some time in consultants and fintech. And I've spent the last year at Thread, formerly known as GPS. So my role is to really lead the pre-sales function and work on how can we work more closely with partners in the ecosystem, but also helping us really work closely with clients in helping develop really compelling propositions and providing kind of solution engineering support for them. So it's a really interesting space because every day you meet a client who wants to develop something new and impressive, and you get to help them along the way.
Fantastic. And it's a big Fintech Insider return for Scott Abrahams, Executive Vice President, Global Channel Partners at Mastercard. Welcome back to the show, Scott. What have you been up to since you were last on the podcast?
Wow. I mean, thank you for reminding me. It's 2.5 years, Ben, for a start. I had no idea until we spoke earlier in the week. That's quite scary. It's a real pleasure to be back, actually. Thank you so much for the invite. Yes, so, my background, I worked at Sainsbury's supermarkets for a long time, Barclays and Barclaycard, American Express, and now here at Mastercard. My former life here was the life that I was doing when I was last on this great podcast, when I was mostly focused on fintech, right, in the UK, but spreading our wings across the whole of Europe. And I looked after Monzo and Revolut and many successful UK-based fintechs. Now I moved into a role which is global in nature, focused on two big lines of business. One is business platforms. So I look after our relationships with the likes of SAP around the world. Huge commercial payment opportunities for the likes of Mastercard there. And secondly, I look after a team called Global Channel Partners. Now, everybody defines channel partners slightly differently, right? For me, my role is to build out exciting enterprise relationships with commerce enablers around the world. So the likes of, for instance, Shopify and WooCommerce and Wix and so many others. Those businesses have an incredibly large influence on our network. And we as a company are keen to be working closely with them. So that's the job I've been doing for the last, 18 months now, actually, now I kind of think about it. I'll get good at it at some point, Ben. Just hold your nerve, it will be soon. So it's a really good to be here. Thank you for the invite.
Well, fantastic. And welcome back. So let's get into the news. Our first story this week is that Visa has launched open banking in the United States through Tink. Tink is a payment services and data enrichment platform which was bought by Visa in 2022. Visa has launched a brand new open banking offering across the United States through Tink, which means that users across America can perform a variety of financial tasks, such as confirming their bank account details, conducting real-time balance checks, retrieving transaction information from banks right across the United States, all through a single interface. According to Visa's own open banking consumer survey, 87% of American consumers use open banking to link their financial accounts to third parties, but only 34% are aware that open banking enables these services. And this comes as the Consumer Financial Protection Bureau finalizes its proposed open banking rules, which could come into force later this year. So, Jonathan, how big a deal is this for Visa, launching in the US through Tink? I mean, it's great to see a European company, having success in the States, but is this a big deal?
I'm sure it's a big deal for Visa. We have seen Mastercard and Scott can talk about it, have had Finicity in the market as well for a while. I think what I was working in the US, what I saw was, firstly, Europe and the US are incredibly different markets in that the scale of opportunity in the US is so much easier compared to the EU, which is really still a highly fragmented market. And so I think what you'll find there is that if the opportunity is there, it will be successful. And I saw lots of areas where, because of probably the lack of traditional infrastructure in the US and still quite a heavy check market compared to Europe, there's a lot of functionality that doesn't exist there. So I think that it will get deployed in ways that are helpful for many of the kind of fintechs to get up and going. And I think the regulation will probably take more of a control lens than it will in the EU, where it was largely around, I think, about driving innovation and change. And I think that's been part of the problem with open banking is it's been a kind of technology looking for a problem to solve. And I think what I noticed a lot is that many players would try and solve for payment types. So I don't think there was really a problem. So trying to use open banking as an example, as a payment instrument in a face-to-face environment, doesn't really make sense to me when, probably a contactless transaction, whether that's using plastic or Apple Pays, working remarkably well. So why am I going to want to log on and start going between apps to get this sort of thing approved? It just doesn't make sense. But on the other hand, there's lots of transaction types where, like subscriptions, where cards have not been as successful. And I think, cards have been incredibly good at adapting to a number of different use case and acceptance channels. So, when online payments came on board, cash and check didn't work, and cards worked very well with some adaptation from players like PayPal. And then it's interesting because many of the banks that I saw when I was at Visa had quite ambivalent attitudes to Apple Pay and Google Pay, but they have been so helpful for the consumer and for banks to stay relevant in that transaction in a way they wouldn't otherwise have been. And so I think cards have been very versatile, and the range of functionality they offer with things like chargeback rights and stuff like that will work. So I still am somewhat skeptical of how much really open banking provides kind of new forms of plumbing for services. It's not really a product, and I doubt the customer really cares that much about it. But what I do think the big differences between the US and the EU is that the usage of it to draw with kind of customer-based propositions front of mind from the outset will probably be more to the fore than it was in the EU, where it was kind of built, and now people are looking for applications of it and struggling in some cases.
Definitely, Europe and the United States definitely took completely different approaches to open banking, didn't they? Scott, do you agree with Jonathan's sort of analysis? Is that somewhat similar to what you've sort of seen and heard at Mastercard from the North American market?
It's a very good summary. I think from our perspective, as always, we welcome competition. You won't be surprised to hear we keep quite a close eye on Visa's announcements and what they're doing. I don't think I'm letting anybody into any secrets there. I do. We still see open banking as a huge opportunity. It's a core part of our strategy. Part of our strategy is what we call new networks, applying the skills and knowledge we have to a globally consistent 3 billion user-based payments network and applying that to potential, networks nearby, such as open banking and perhaps digital identity as well. So we still see, we still believe that there are opportunities within open banking that we should be supporting, encouraging, building. I agree with Jonathan, though. One of the challenges, and as you say, we've seen different ways of doing it, whether it's the US or Europe. Our operations in Europe are always looking for ways of, more easily moving money across borders, more alternatives in terms of payments, and we partner with them and encourage those efforts. But cards are pretty good, right, in many ways, and particularly the payments elements of open banking. We have a number of use cases live in the UK, mostly sort of paying yourself for things or paying off your credit cards. Very successful though they are, that they're relatively niche still compared to the sort of global dominance of payments. I do think though that there is still something there, right, in the long term, and I agree with Jonathan. I think where you've got, if you open it up to the market rather than try and regulate it first, that tends to be where entrepreneurs and ideas and excitement comes from, and we see that a lot in the US, and to be fair, sometimes we see it in Europe going the opposite way. But I think from that perspective, I also think, to be honest with you, that from our perspective, we welcome that competition. The more people are thinking about it, the more hopefully some exciting things will come from it, right? And so from that perspective, but I do think as well, Ben, in your introduction, you spoke about the fact that a lot of people are using it and don't know they're using it, right? That's got to be something the industry has to consider. We have very strong privacy policies in place that we're constantly strengthening. We think it's important people know what they're doing and how they're doing it and how their information is being used and who they're sharing it with, and the fact that they still own it as much as anything else. And, I think that's still something that we as an industry need to keep considering, thinking about and working on.
Yeah, open banking definitely has a branding problem.
I think also it's one of the core blocks. So I think APIs enable interconnectivity. So you've had these very rigid stacks, but I still think that, what we've seen here is if you don't have good risk services. So I think tokenization, look at the impact tokenization has had on enabling the kind of opening up of cards. I think the missing piece for open banking to really grow, and I'm not the first person, I'm sure I won't be the last person, is some form of digital identity and credential that's kind of interoperable, which again is largely what Mastercard and Visa provided with their networks. And so I still think that on a standalone basis, people need to look at this a bit more holistically and look at how do we kind of combine the open standards with the requisite services, whether those be authentication, credentials, ID, to build out compelling propositions. Because a payment rail on its own is very useful, but it doesn't solve, and we will see a lot of risk in this ecosystem. And what concerns me again is, what we have seen in the UK is regulation has driven much more of the behavior from a compliance standpoint than a proposition standpoint. So now everyone is all the focus is on how do we stop scams, because it's regulated and it's costing us business. So I worry as well that the banks were forced to open up their walls a little bit, but if they can quite, in some cases justifiably point to the degree of fraud, it kind of leaks into the ecosystem, particularly if they're being then expected to fund, because, in every circumstance, they're kind of looking after the consumer versus the bank. It's just not a workable or sustainable model in the long term, I don't think. So, these issues need to be addressed some shape or form. And I think a more commercially driven market like the US will hopefully provide some really interesting pointers for the way to commercialize this and make this work in the future.
Yeah, some really lovely points. I'm interested. We started talking about this, and we sort of immediately focused on payments, and not unnaturally, because of course a lot of
What is there something else, Ben, that I missed? Sorry.
yeah.
My mistake.
Well, yes.
I thought payments was all it was.
Because I mean, but I suppose that's my question to you, Scott, because we naturally think, because it's Visa doing it. Oh, is it competition for Mastercard? But actually, is this competition for Plaid, or is this competition for all sorts of other sort of information providers? This is really about the data play, and how do American businesses get better data about their customers and do, to Jonathan's point, imaginative things with that helps people with their financial well-being. Or
can I just ask, Ben, is the usage of Plaid as a comparator with the Visa legacy deliberate or accidental in this case?
Yeah,
I'm being a bit naughty there.
There was not an intentional dig.
Mastercard will not come on that either before you. I think it's an interesting point. I think, to be honest with you, this is just Scott Abraham's view to some extent. Excuse the pun, there's lots of money in payments. Right. And so you often get to payments quite quickly because you think, God, that Mastercard makes a few bucks every quarter, and Visa do, and acquirers and all of these things. So I think it's harder sometimes to commercialize data immediately. Right. And so if I can make 5 basis points off the flow, I'm going to get 5 basis points today, right? If somebody is going to use my data that they commercialize in a way that they end up selling something or making something, I then have to negotiate what that is and how I get that, and how I share that. It's more complicated, right? And ironically, the exchange of data is easier from an open banking perspective. So that's just my view. Perhaps that's part of it. And when I led our fintech business here in the UK, that was why most of the entrepreneurs I met were getting involved with payments, right? Because there was opportunities within it. And if you worked with somebody like ourselves or Visa as an issuer, you would immediately open yourself up to a market of 115 million places around the world to use your product. That's all pre-installed and done. Right. And so, that's something that I think I sense that's why, to some extent, payments and open banking were the thing that people focused on, because there could be, I don't think there has been yet, but there could be an immediate revenue opportunity that some of the data things they take longer to work out. Sorry, Jonathan, I spoke over you.
No, I was going to add as well, which is, having been around as long as I have, one of the things you realize, this is all about managing the risk. And what Visa and Mastercard have done remarkably successfully is created an ecosystem which isn't just about cards or technology. It's about a set of rules and kind of interoperability capability, but fundamentally as well, it's a risk management exercise, and you have intermediaries who kind of guarantee the risk on behalf of everyone.
Well, it's a risk balancing exercise.
Yeah, absolutely.
Right, that's what it is. Yeah. It's a risk balancing exercise.
And I think what PayPal, for example, did very well when they first came in was created a model which kind of gave the customer reassurance, but created a kind of risk management capability. And in some cases, I think they took on the risk because they'd done much better authentication and they had much better risk management systems. So any of these services that want to scale without thinking through the implications, and I struggle, unless it's on a domestic basis, how a kind of multi-market does that without some form of scheme and interoperability. I really think it's hard to imagine how that works otherwise.
Let's move on to our next story, much as I'm loving this conversation. But the good news is our next story is also about payments, which is that Mastercard and PrestaShop are to deploy click-to-pay in Europe. So e-commerce provider PrestaShop is rolling out Mastercard's click-to-pay function in several large European countries, including France, Spain, Italy, and the United Kingdom. Click-to-pay means that customers can use their bank cards for online payments without having to enter their details or password. Instead, payment information is stored in a single profile to make online checkouts easier and faster for the customer. It uses tokenization to make it more secure. With this method, card details are turned into a non-sensitive set of characters, which means those card details are not visible to anyone else during the payment process. If the rollout is a success, PrestaShop intends to expand its click-to-pay service to other countries, both in Europe and around the world. So, Scott, we're going to come to you first on this for obvious reasons. So congratulations to you and everyone at Mastercard for this. Can you tell us a little bit more about this and why PrestaShop was your sort of partner of choice?
Well, PrestaShop have been a great partner with this. I think let me just go back one step before I get into that. So, and Jonathan will know this of his years of experience of working at Visa. We every day our network gets a bit more complicated than it was the day before, right? As our network expands, more businesses interact with it in some way, and our network is leveraged by more businesses in different ways. It becomes more complicated. Our network is quite simple at its very basic level. We have issuing licenses and acquiring licenses, businesses that capture transactions and businesses that issue payment credentials. What we've done, I think, quite successfully over the past few years, though, is expand our relationships way past that. We respect our issuers and acquirers hugely. And, our four-party model is at the core of everything we at Mastercard do. But we also understand that there's many other players in our network now that have an outsized influence on how things are happen. And that's why we're partnering with the likes of PrestaShop and some of the others that I mentioned in my introduction, Shopify and Woo. And, we are building out our relationships in different ways with many of these businesses, knowing that they are at the tip of the spear when it comes to payments, and knowing that so many merchants prefer using their services as a way of both getting online and also then taking payments online. So that's what's behind this overall. I'm very excited about this. Is the first time we've done this. All of the work we've been doing on implementing Click to Pay, both supporting the EMV initiative of Click to Pay and doing stuff ourselves, has been focused on merchants and or acquirers, which we will continue to do. This is bringing in another party that we feel has an outsized influence on how transactions are happening at the point of sale. And that's why we're working with PrestaShop. And they've been a great development. We've learned quite a lot through this, right? As anything that you do for the first time. But they've been great partners. And we truly believe that we can actually deploy Click to Pay effectively, quickly, and with great quality to many more merchants by doing these types of things.
How for consumers, how does this look different to using something like Apple Pay or Google Pay or Amazon's one-click checkout? What kind of experience is this going to offer consumers at the checkout?
Well, as you put in your details, it will then automatically present your card credentials to it. So you won't, it doesn't quite feel like you're getting to it through another third party, if you like, Ben, would be the best way of describing it. The standards of Click to Pay are both, rooted in EMV and also agnostic. So they're not focused on one browser, one operating system, one merchant, one network. And that is probably the main difference between the likes of Apple Pay and Google Pay. Also big partners of ours. So, we're happy with that competition, and we're happy that so many of our products are plugged in to those products. And of course, our products are tokenized in all of those instances as well. So we're very happy about that. My view is that over time, it's our intention that Click to Pay is similar in nature to the way we implemented contactless, right? It is just the way of using Visa, Mastercard, Amex, and others online over time. We've tried a number of different approaches here. The cards network has tried a number of different approaches here. I think this approach is the right one because it seeks to exist alongside those other ways of taking payments, to coexist, to give more choice. This feels like it's coming from your bank more, Ben, as well, right? In some ways. And so for all of those reasons, we think it's an exciting thing to be doing. It's an exciting thing to be doing with Presta because we think it's a more seamless way for merchants to actually interact with Click to Pay than perhaps some of the things that we've been doing beforehand.
So I think you're saying it's essentially just a better way of paying with a card online than the current ways. This is just a sort of an improvement to online card payments.
Exactly. Yeah. And of course, you look today, I mean, I have an iPhone. I use Apple Pay quite a lot. Often my credentials magically appear anywhere from Safari in some way or other, right? This is about consumer choice as much as anything else, but it's agnostic, and that's really important, right? It's about your bank and the merchant rather than anybody else.
Jonathan, do you think this is great news for consumers? Is this something that's sort of long overdue, or is this just yet another thing people have got to think about at the checkout, yet another option being offered to you?
Tough question, John. I'm looking forward to hearing this answer, by the way.
So in full transparency, I think when Benjamin and I first knew each other, I was responsible for one of the payment network wallets called V.me. Does anybody remember that? Later Visa checkout. So I've been on the front lines.
I saw it on your LinkedIn profile, Jonathan.
Yeah, I still carry the scars. So I've had firsthand experience of the challenges of trying to kind of engage in this, and so I wish everybody luck, but I do think that trying to get that chicken and egg of critical mass of consumers and critical mass of merchant adoption is really interesting. I think there's two key things that are probably, and Scott would be much closer to, so I'm not in a position to offer anything on Click to Pay itself, but what I would say is that I think there are a couple of issues now. One is what we have seen is, and I think this is a problem for acquirers and cards generally, is that you effectively have a number of different infrastructures. So you've got kind of face-to-face, and you've got online, and in some respects you've got in-app, which is kind of a hybrid. But it's often you're using an online, you use one kind of wallet for online and another. And so where I think Apple Pay has been successful and Google Pay is, it's probably more omni-channel. So I suspect that having kind of like single channel wallets will feel somewhat lesser to the utility of that wallet. Even if as I mentioned earlier, I think Mastercard and Visa have done an exceptional job of increasing the adaptability and versatility of the card. The second is, I think now what we're seeing is the value-added services that the customers are looking for in that wallet. So things like buy now, pay, like Monzo has put a virtual card linked to your physical card in the wallet, and it offers things like buy now, pay later. I think we're early doors on kind of rewards functionality. So I think the kind of feature functionality people are going to be looking for beyond pure acceptance. I think acceptance is just one element in a line item of kind of services they're expecting from a kind of a wallet, as we would call it. And I think that's good for the customer and that kind of growth in functionality and adaptability. But I think it's going to be interesting to see how adoption fares for Click to Pay, because certainly it's been a tough road in the past for Masterpass and V.me, Visa Checkout. And so I wish everyone luck this time around.
Yeah, they're tough, those consumers and those merchants.
I think, Jonathan, you make some good points. I have some of the, I worked on Masterpass here for some time. So and of course, and Visa had two different wallets, right, at the time, because it was Visa Europe and then Visa Inc. as well. Never have enough wallets, can you? And so, look, this is very different to the wallets, right? This is a way of serving up your credentials that have been tokenized at the point of checkout by using other information that you always have to use anyway, right? And so I think that gives me confidence and hope, because it's not the same as the sort of wallets that we were trying to implement a few years ago, to your absolute right point, Jonathan.
And I suspect, Scott, your banking partners are probably more realistic. And, one of the real challenges was all these banks were trying to kind of think it was going to be part of their banking app and their wallet, and that didn't work at all. So I think there's a recognition that having a trusted intermediary helps.
That's a really good point, Jonathan. Yeah, and but pay with Bank X, pay with Bank Y, pay with and that ship has certainly sailed. And of course, we had all the mobile network operators kicking around then as well, thinking about different things as well that you'll also remember. So yes, look, I'm not suggesting for a second that this isn't still a long, hard road. The other difference is that this is an EMV initiative, Jonathan, right? Rather than us doing something and Visa doing something else and Amex doing something else. So there is an element of that as well, which also gives me more confidence. We will still compete within those confines, but that's it. So I'm not here saying it's all done now, everything's going to be great. I just think this is a big step forward for us, though, because we are understanding our network and understanding that we have to work with more players than ever. Right. And to be fair to Visa, I think they're thinking along the same lines, to be honest with you. So, that's this is a good example of that.
A last quick question to you, Scott, just to wrap up on this. Where are you expecting to have the most success, or where are you expecting to see the early success? Which sort of sectors, which customer groups, what are you hoping is going to see the fastest sort of take up?
I think where we expect to see the fastest take up I expect to see very fast take up from these types of partners, right? And so because we're operating at the point of sale, if you like, the people that are actually providing the point of sale, the websites, the shops almost, I think there will be a lot of take up there. Most of their customers are smaller and medium-sized customers, right? I from that perspective, many of us have our details stored at certain sites that we go and shop at a lot of the time already. Now, I'm not writing those off in the future, but as Jonathan will attest to, that's a harder slog to get some of those businesses to adopt this stuff straight off the bat. They will already feel that they have more card details than most banks in the world already, actually, right? So there aren't particular sectors. What I would say is where you are buying things that you might buy once a year, say, where you're not going to leave your credentials with them. You may not have quite the level of trust that you do with some of these big retailers, etc. That's where I think we'll begin to break through. And then once we break through there, of course, the trick here, just like it is in basic card acceptance, is get consumers to start asking for these things rather than being surprised about them. I'm not suggesting we're quite there yet, but that will obviously be where we start to ride the tidal wave then, and let's hope that comes soon.
Indeed. Well, indeed. So great work by you and all of your colleagues at Mastercard, and
it was great work by my colleagues, Ben. It was nothing to do with me, as always.
Well, thank you for representing.
Unless it goes really wrong, of course, then it's all about me.
All right. Well, on that note, we're going to take a very quick pause here, and we will be back very shortly. Welcome back. Before we get into the second half of the show, a quick note to check out our most recent Fintech Insider Insights show. In the second part of our How to Buy a Bank series, Kate Moody discusses what happens inside a bank during a merger or acquisition. She's joined by Dave Morris, Global Head of Technology here at 11FS, Rupi Malizia, Chief Strategic Transformation Officer at HSBC Innovation Banking, and Mariella Hunter, a Fractional Chief Operating Officer. They chat about everything from merging two tech stacks to keeping employees motivated during a time of massive change. And let's be honest, change like this can be really scary for people. So we break it all down for you in our How to Buy a Bank Part 2. Please check it out in the podcast feed. It's the one just below this one. And in that spirit of mergers and acquisitions, let's move on to our next story, which is that Republic First Bank has closed and been sold to Fulton Bank by regulators. Republic First Bank is the first US bank to fail in 2024. Now, some of you listeners are probably getting a bit of a sense of déjà vu and thinking, hang on, didn't Republic First Bank close last year? No, that was First Republic Bank. And no one can accuse the American banking industry of not having imaginative banking names. So the closure and sale comes after Republic First Bank reported last July that it was trying to bring down costs, adding that the value of its mortgage book had dropped substantially as interest rates continued to rise. A $35 million funding boost was on the cards, but the deal fell through in February, marking the start of the end for Republic First. The bank held $6 billion in assets and $4 billion of deposits, and the estimated cost of its failure is $667 million. All of its 32 branches across New Jersey, Pennsylvania, and New York State will reopen as branches of Fulton Bank. Fulton's management says it expects to receive roughly $1 billion from the Federal Deposit Insurance Corporation as part of the transaction terms, and its stock was actually up in afternoon trading. So, Jonathan, interest rate rises. Good news for banks, bad news for banks, or does it all depend on what's sitting on that balance sheet?
Can I just say, Benjamin, firstly, I have to get the image of Monty Python's Life of Brian out of my head. The Judean People's Front complaining about... I have visions of people in First Republic Bank going, those Republic...
Yeah. The People's Front of Judea.
People's Front of
Exactly.
Judea. So now I've got that. Look, I think that any rise in interest rates always has a significant impact on the market. And so some of this has not been unsurprising. And some of that is kind of almost natural correction of the market. But I think what we are now starting to see is, as well, what you had was a lot of business models growing, which had a very high risk appetite. And so what I think we're starting to see is that kind of perfect storm of, credit failures, increasing regulation, and I think far more greater concern about things like compliance. So I think the controls that are going to be put in place, certainly in my ecosystem where we're dealing with BIN sponsors and fintechs and startups, means you're looking at an incredibly different landscape than particularly in the US, than you were 3 or 4 years ago when I was working there, from a kind of risk appetite and a willingness to support some of these emerging models. So from a selfish standpoint, I don't think it's good news. I think that another segment I've always been very close to, things like small business, have struggled and have always had difficulty getting access to funds. I think some of the emerging credit models will make that a bit better than previous recessions I've worked through. But I can't stress enough just how much more cautious, more kind of demand for compliance and control that we're now starting to see in the ecosystem than we saw 18 months, 24 months ago.
Thank you. Scott, Republic First Bank apparently had 50% of its loan book was commercial real estate. Should that have triggered alarm bells? I mean, is that just too much betting on one segment of the market?
I mean, personally speaking, it does feel, as you rightly say, that they had a real concentration risk in one particular area, and I think it goes to the points Jonathan was just making. That perhaps part of that control and compliance environment that is heightening will be around. What are you really exposed to here? What are the big risks in your book? And this is just my perception rather than talking necessarily on behalf of Mastercard. I do see a level of what I would call regulatory proactivity that perhaps we saw what happened in Switzerland last year and here now, that there does seem to be a more proactive regulatory approach of, this bank is in trouble. Let's find a way of saving this bank, and perhaps still going to the wire, of course. But I do feel that there's a level of proactivity coming into regulators that, dare I say, perhaps wasn't always there in the past. And you've got that sort of the balancing of protecting consumers versus allowing a market to operate. I think I see some changes in that, and for me, looking a bit closer to home, I saw a lot of those changes actually when through the failure of Wirecard a few years ago, right, which I was very closely involved with here at Mastercard. You would think that, wouldn't you? You'd think, hold on, we've got most of our eggs in one basket. There is an element of, but I'm not on the ground, I don't know, and the challenge is, of course, I think a lot of the time. And having worked in acquirers for a long time, when you're constantly concerned about your exposure to industry X or industry Y or industry A, the opportunity for just one more deal is always there, right? Because these deals tend to be good margin deals, right? That's why they're on the books. And so there's always, human beings are like, oh, it's just one more, and perhaps that's part of it as well. And as much, I completely agree with Jonathan from a control and compliance
standpoint. Of course, yeah.
It's human beings, right? And there's a good deal to be done, and it's there, and I'm sure that other businesses are in similar, exposed in similar ways to some extent.
We've invested heavily in kind of building out things like fraud transaction monitoring capabilities and 3D, and all this compliance services, just because it stopped almost becoming optional. And so we're seeing partners of ours who are saying, if they're not using these services, we won't even consider them. And so they're becoming core embedded parts of our package in areas we've invested heavily in, because frankly, as I said, they're not optional, they're required if you need to help a client get a program off the ground. It just, things that were possible and allowed 2-3 years ago just would never even going to hit the runway these days.
That's a really interesting point, that at some point, because the ecosystem, everyone in sort of fintech is so dependent on partners, that if you don't have adequate risk controls in place, you could get to the point where other firms don't want to partner with you because they start looking at you and start saying, hang on a minute, there's a risk here. Scott, I'm not going to ask you this as Mastercard because that's unfair, but as an individual, do you think that hypothesis has anything to it, that there might be sort of maybe slightly higher risk financial services businesses that actually find people don't want to partner with them because they don't want to be associated?
I think there's a few things to be said on that. I think it's always been this way, but I think it's even more so this way now. When particularly in my last job, but even in this job now, I think one of the encouraging things I see is a lot of senior people in I'm not going to say the more established banks, because I think that's been there for a long time, but there is an understanding that to be successful, you've got to be the best at all this stuff as well. You've got to be as compliant as you possibly can be. You've got to have the best risk management, the best fraud, the best, and those ones that are most successful have seen that as a competitive edge and point of differentiation, rather than something they've just got to do to survive and and operate day to day, because that's what the FCA wants them to do, or the PSR wants them to do, or the Bank of England wants them to do. Now, that I think most people in our industry would probably say that now, but I think more people are saying it and meaning it now, and that I think is the difference, to be really honest with you from that perspective. And so I do, and again I go back. I mean, as I said, I worked with many partners through the challenges with Wirecard, and of course it's only when a business isn't there you start to realize how embedded it is in so many things, and how complicated it is to unpick it all. I'm very proud of the work we did there. I think we and Visa were involved, of course, many other businesses were involved. I'm very proud of that, but it's only when you take out one of those sort of cornerstones, you realize, wow, this is quite complicated now, right? And at the end of the day, there is a poor consumer at the end of it who has no understanding about all this stuff, who is worried that his or her money isn't safe. And certainly a lot of the actions that I saw at the start of the challenges with Wirecard, rightly so, from the regulators, were about that rather than anything else. And so that's where I've seen changes over the last few years, because businesses are now coming to market understanding that's got, and I think, to be fair, trusted businesses such as yours, Jonathan, such as Thread, that's a competitive difference, right? That's a way of being successful now, rather than a way of just surviving, if you like, right? There's a big difference.
Scott, you raise a great point. So, within the last year, a very well-known bank lost its license. And overnight, we had to work really closely with organizations such as Mastercard and finding other sponsor banks, keeping, successful programs running and kind of handling that migration process really mid-air. Now, that's a hard thing to talk about when you're dealing with kind of new arrivals on the scene. But the degree of education that is required these days is significantly higher. And to your point, having a trusted partner and also really good because it's kind of the three legs of the stool, the bank, the payment network, the issue processor, all of us really need to be helping each other and working hand in hand, because you've only got, it's only going to have one failure point, and you can have significant challenges And the kind of and what we've seen with things like crypto is the reputational impact of some of one or two players going down can be huge and long lasting.
Jonathan, that's a great link into our next story, which continues the regulatory theme around crypto. So thank you. So our next story is that the European Union is expanding anti-money laundering regulation, which is affecting cryptocurrency compliance. This was reported in Finextra and various other places. So the European Parliament has voted to adopt new laws that strengthen the EU's anti-money laundering and terrorist financing toolkit, with a particular effect on crypto. The new regulations will create enhanced due diligence on customers' identity. Banks, cryptocurrency asset managers, and others will have to report any suspicious activities to financial intelligence units, or FIUs. Under the new rules, these financial intelligence units will have more power to analyze and detect money laundering and terrorist financing, and to suspend suspicious transactions. They will all be supervised by the newly created Authority for Anti-Money Laundering and Countering the Financing of Terrorism, which is apparently abbreviated to AMLA, but there seem to be a lot more letters involved. So leaving aside the creation of yet more acronyms in an industry that doesn't need more acronyms, Scott, is this overdue? Introducing more regulation around cryptocurrency and understanding, where those payments are going. I mean, there's a school of thought that, that cryptocurrencies are actually being used for nefarious activities rather more than they ought to be. Is this overdue? Is this a good move by the EU?
Well, I think if cryptocurrency is going to reach some of the opportunities that so many people believe it will, both as and not just a sort of an asset class and an investment tool, if you like, then to some extent it will have to be treated in a similar way to many other areas of finance that Jonathan, you and Ben, we work in today. And so I think from that perspective, and of course it's all about balancing risk, as Jonathan was talking about earlier. But from that perspective, many of the businesses involved in this already have very strong AML policies and procedures. And so we at Mastercard believe that our central role is trust. Right, we insert trust into any transaction. You can go on a plane tonight, land in Brazil, pay a restaurateur, and you'll expect that payment to work because of that logo on your card, right? And I would argue that perhaps in crypto, outside of it as a way of trying to make some money or not, that trust is still not there as much as it perhaps could be, and perhaps would be holding it back in the long term from some of the future that many people would perceive it to have. And so from that perspective, I think it's necessary that these types of things will start to happen. And we've seen a level of proactivity from Europe on these points for some time, to be fair to them as well, right? And we at Mastercard, again, going back to what Jonathan was saying, to some, we welcome this not because we feel that it makes consumers safer. We welcome it because we feel that we're well placed to support businesses doing this type of thing, to be honest with you, right? Not only in our cards network, but in the networks we own and run through acquisitions such as Vocalink, right? We monitor billions of financial transactions and work with central regulators, central banks. We have many different products and alerting software that is looking for these transactions already. So from that perspective, we're well placed to do more of it. And so, yeah, that would be my views on that, Ben.
Jonathan, just to Scott's point, I mean, a lot of banks and other organizations already have a huge amount of sort of anti-money laundering and know your customer controls and sanctions monitoring and so on. Do you think more laws were needed?
So let me assume best intent, eyebrows somewhat raised, and that there were no bad actors in the crypto space, and it was all been. You've got a couple of fundamental challenges. You can't deny that finance is the most localized, heavily regulated kind of sets of entities, and so you have this kind of culture clash of people who think that because they operate on the web, that everything is global and works seamlessly. And that just doesn't happen. And people are, I think the belief that people would just kind of let that go long term at scale was naive, if not positively misjudged. Okay. I also think part of the problem is that people in crypto have kind of wanted to have their cake and they wanted to eat it too, which is like, you can either be a commodity or you can be a currency. If you want to be a viable currency, you can't have the fluctuations in value and people investing it for the reasons they have, So I think all of these things are not unexpected. They're not unforeseeable. They're inevitable consequences of the path that crypto has been on. And the expectation that regulators wouldn't want to have control or an oversight. And to be fair, it's not that they're penalizing crypto. They're frankly just treating it to a lot of the same degree of regulation and oversight that banks deal with every day. And just because, and so banks haven't been heavily involved in that, but they're probably saying, well, why am I so heavily regulated and subject to, and if you add on things like consumer protections they have to offer, they're even more heavily regulated and controlled. So no, I don't think it's unexpected. And I think it's inevitable. And, I think it forces, maybe it will force some of the crypto players to really address some of the kind of, I think, core challenges of their model if it wants to be a sustainable model.
Great stuff. So a long overdue alignment of rules to treat crypto much like the rest of the financial services industry, in short.
The last thing I would just add on that, Ben, is I have within my portfolio some the crypto native businesses. I think what's really interesting is the thing we were just talking about in terms of compliance being a competitive differentiator. I'm beginning to see the same attitude when I talk to people in the crypto space. Let's just call it wherever that space is, right? The thinking around being one of the last people standing here, right? Particularly given what's happened over the last sort of 18 to 24 months, is actually part of some of these strategies now in a way that it probably wasn't, right, a couple of years ago. So I think that's the other side to this coin. As Jonathan rightly says, I think this is going to be more accepted than it used to be for all of the things that have gone on in recent times. And so I think from that perspective, I see an attitudinal shift starting to happen that wasn't there before.
And I think to your point, Scott, probably some of the crypto players who were being compliant will actually see this as long overdue as well, and helping their cause because they wanted to mature their business models.
So true. You're right. That's one of the things that I think I've always there's the best players, right, would encourage more regulation in a way, as long as that brought more trust and more consumers and more more confidence in the network. It should be welcomed. And I think you're right, Jonathan, that's part of it too.
Okay, we're running out of time. So we need a very quick look at one more click-worthy story this week, which was that the first quarter of this year saw almost 500 fintech deals. So InsurTech, crypto and blockchain have led a strong quarter for fintech investment, according to data from Royal Park Partners. In the first 3 months of 2024, there were 248 financing deals, totaling 7.8 billion, which is a little bit down on the last quarter of 2023, which saw 14.1 billion in deals. There were also 240 mergers and acquisitions, including the 35 billion Capital One and Discover deal. So good to know that the industry is still in good health with lots of activity. Really interesting to see InsurTech coming through. I've always felt that InsurTech's been a bit of a late adopter compared with other segments of financial services. It's so much opportunity there. And finally, let's take a look at something more offbeat from the world of finance, which is that a woman in Australia has been fired after her company used keystroke technology to see how she's working from home. This was reported in Unilad. A consultant at Insurance Australia Group found herself in trouble after really taking advantage of working from home. She had a warning back in 2022 about her low output, so the company installed keystroke tech on her laptop to keep tabs on her work. They found that she started late on 47 of the 49 days they monitored and finished early on 29 of those days. And in fact, on 4 days, she was found not to have done any work at all. On average, she pressed her keyboard only 54 times an hour. Though the company let her go, the employee claims the data is wrong and has filed for unfair dismissal. Scott, what do you think? Is this a lady who's working on another device? She's constantly on video calls and not really using her keyboard. What's your take on this story?
The first thing I'm thinking now is I'm working at home tomorrow, and I'm gonna aim for over 54 times an hour for a start. Right, if I get something like 60 or so, I think I'll feel pretty good about myself. Yeah, it's quite scary, isn't it? In some way, as you say, there are other devices, right? I often work at home, but I tend to use my phone sometimes for those types of things, and it does point to a severe lack of trust between employer and employee to some extent, right? I think we as a company we're proud of the approach we're taking to hybrid work, but we're constantly changing it. I think if you go back to the end of 2021, Ben, Jonathan, the world was never going to be the same again, was it then? Right? Never going to be the same again. And so many businesses bet big on that being the case. Like we would never want to physically meet ever again anybody. Right? And that's changed. But I'd say we've sprung back really quickly. Actually, if you think about it, we went one way really quickly, and now we've sprung back relatively quickly as well. So we're still working that out. I don't know whether we have plans, and nobody will tell me, of course, if we're going to use keystroke technology here at Mastercard. But if I don't ever attend another one of these calls, you can probably assume that they did. All right.
What do you think, Jonathan? Is it overkill tracking like this?
So I think we are living in an age where increasingly, we were talking beforehand about, read AI, meeting notes and people. So I think gradually we're seeing data being processed about us for a variety of different reasons. And I think, different markets will probably have very different attitudes as to whether that's an invasion of privacy. Even if you're working, wherever you're working, you're like, what data about for me is shareable and in what context can it be used? And I think it's another example of so often technology is being used and evolving so quickly that I think we don't always know how to keep up with it as quickly as we need to. I mean, my defense, if I was here, was probably, you could be sitting in a Teams meeting and you've just tapped the join and then, you've got no more keystrokes for that hour because you're just watching the Teams meeting. But I do think that it's interesting how much of our data is being consumed with or without our knowledge. And I think that I get a sense that there's probably an increasing set of discomfort if you look at the number of, articles and programs that have got people's concerns about AI and the implications of it going through. But I suspect a lot of it is inevitable. And let's see what happens when some of these cases get challenged, as I suspect they will be.
I'm really hoping you're wrong, Jonathan, that this is inevitable, because I read this story and I was like, well, surely this is going to make a lot of people think twice about working for Insurance Australia Group, because and does this actually indicate sort of bad management, that they couldn't sort out this apparently unproductive employee? But in defense of Insurance Australia Group, I should say that apparently failure to do certain tasks got them into trouble with the regulators because she didn't file certain things she was meant to file on time. So I don't.
If only she was keystroking 56 times an hour, that wouldn't have been a problem. Hey, Ben?
Yeah, maybe she just needed a bit more motivation, perhaps. It is a great story, but I hope we don't have more stories like this. I hope Jonathan proves to be wrong on this. I'm sure he won't. But
as someone who's worked in the US, I can say that the US have a remarkably different attitude to data privacy than Europeans do. So I do think it's interesting that some of this is cultural and geographic as well. even though the technology would probably work the same way, there are very different attitudes in very different markets.
Is what I was saying before we started the call. As a global business, is absolutely right. The difference in attitude between it, but the difference in attitude even in the coast of America, let alone here and Italy and Eastern Europe and Asia Pac, and it's incredible. And it's interesting. You made the point, Jonathan, about being on a Teams meeting. It's amazing these days. One of the challenges I have is that people just think you're much more accessible than you used to be, right? You can always send a quick text message on Teams or whatever it is. And it's been nice the last hour because you can say, well, I haven't, but I've just focused on one thing for an hour. It's amazing. I haven't done that in a long, long time, and so this has been very enjoyable for that. But I'm now going to frantically tap my keyboard for 2 minutes, though, just to make sure that I bang a couple of 100 keystrokes in there before I leave anyway.
Well, on that, thank you both so much for making this past hour so enjoyable. And that wraps up this week's Fintech Insider News. Thank you so much to my guests, Jonathan and Scott. Where can people find out a little bit more about you? First, Jonathan, where can people find out a little bit more about you?
Present on LinkedIn, but also please go to thread.com and have a look at frequently putting articles and information up there. So that's a great place to go. Thank you.
And Scott?
LinkedIn is the best place for me. I'm pretty active on LinkedIn. So Scott Abrahams, Mastercard, LinkedIn, that's the best place to go for me.
And as for me, Benjamin Ensor, you can find me on LinkedIn as well. Thank you all so much for listening. I hope you enjoyed the show. If you want to join the conversation, please find us on social media. Just search for 11FS or Fintech Insider or email us at podcasts@11fs.com. Thank you so much and goodbye.